Here we are, 2012, San Francisco Hard Asset Show.
So let's get started. First of all, I'm delighted and flattered to see so many of you here at 7:40 in the morning. I've, as many of you know, taken these early morning shots for years, figuring that the audience self-selects, that people who came to San Francisco because they want to get away from the wife and go out to eat and stuff like that. We're all fine people, but I didn't want to talk to them. I wanted to talk to people who were ambitious and greedy like yourselves. And, regardless of what they did to themselves the night before, were willing to be here drinking coffee at 7:40 in the morning. I found that dedicated audiences are audiences that are more fun to talk to. So first of all, flattered that so many of you decided to come. So let's get started. Interviewing mining company managements. The first thing is that increasingly the management teams have been schooled by investment bankers to have a pitch. They have a script. And the easiest thing for you to do is show up in front of the booth, push a button, and they give you a script. And the script is often, I'm not saying always, but it's often designed to minimize the wear and tear on the executive, as opposed necessarily to educate you about the affairs of the company. There's nothing wrong with that. The executive that's talking to you is necessarily charged with creating value for you in many ways, shapes, or forms, not just talking to investors. But it's up to you, not to them, to get the information that you need. And so, while it's useful, if you would like to sit through the pitch, and most of these guys are proficient, they can get through it in 7 or 8 minutes. You know, they flip the charts and stuff like that. And if you don't ask too many questions in the interim, which is a good thing to do, don't ask questions. Let them get through the whole chart and say, okay, now let's get down to business. You're trying to ascertain a few things. But before you do that, you need to orient yourself as to what you're doing in the business. And when I say mining company managements now, I'm talking mostly about the juniors, the exploration stage companies. It's important for you, first of all, to understand that value is created in the juniors, in exploration, by answering a series of unanswered questions. That's how value is created. Don't worry too much about when options exercise periods happen, when hold periods come off. All that stuff is interesting, but it doesn't really matter very much. What matters is, are these guys going to make a discovery? And if they make a discovery, is it worth anything? Do they have the competence to make the discovery? That's what you're careful about. And the first part of exploration, by the way, how many people are here from the San Francisco Bay Area, Silicon Valley, all that? Okay, a lot of you. A big mistake that we all make in this business is that we assume that these juniors are asset rich. We assume that they're asset plays. First of all, remember this. Most exploration properties have no proven reserves. And an intelligent accountant would probably put them on the balance sheet as liabilities, that is, the obligation to spend money rather than assets. So when you think about this business, don't think of it as an asset-intensive business. Think of it as an intellectual property business. These are really research and development businesses, just like people who are doing biotechnology or software. These guys are answering unanswered questions in an exploration process, which is very much like research and development. So if you think about Nevada gold exploration the way that you would think about Silicon Valley microelectronics or software, you begin to understand the process better than you would thinking about it in some other fashion. The consequence of that realization is that in the earlier stages, people are more important than property. People are more important than property. And the first thing that you're going to do in analyzing a junior company, in interviewing mining company managements, is you are going to do an inventory of the intellectual capital associated with the company. And so hopefully in the booth you can start with the CEO, start at the top. Many people say, but Rick, you know, the CEOs will only talk to you. They won't talk to us. That's not true. A passionate CEO in any business is somebody that is so driven by his or her mission that they don't want to talk about anything else but their business. They're like me. They can't talk baseball. They can't talk movies. They don't give a damn. It's just what they're doing. They will talk to you. And if they won't talk to you, that makes the decision easy. You throw the presentation away and leave. It's really, really, really simple. So you start with the CEO, and you say to the CEO, what are you doing? What is this company about? And what are your specific skill sets? What have you done in the past that qualifies you to take my money in this endeavor? What specific skill sets do you have? And tell me how you were successful before, not just for yourself. I mean, if you happen to drive a Rolls-Royce, I think that's wonderful, but how many other people are driving Rolls-Royces as a consequence of your earlier activities? Because one of the things that we learn in this business, how many people here are familiar with Pareto's Law? Few of you, so I'm going to bore the ones that are. Pareto's Law is the 80-20 rule, where 80% of the utility in a given task is done by 20% of the population base. And it's important to note that it's a bell-shaped curve. That's important because there's two 20s. There's a good 20 that does 80% of the good, and there's a bad 20 that does 80% of the bad. And it's odd, but these performance dispersal curves work over many population subgroups in many tasks. What's also important to know is that the ellipse, the good 20 and the bad 20, if you run them through the same performance dispersal curves, they conformably align again, which is a different way of saying that 20% of the 20 do 80% of the 80, or 4% of a population base generates 65% of the utility and 65% of the disutility. And probably conformably aligns again, but we'll leave that alone. The third standard deviation we don't care about. What that means in just plain English is that 4% of the management teams generate 65% of the capital gains. And your job, interviewing mining company managements, is to at least find the good 20, and preferably the good 4. That's what we're about. There is no guarantee that somebody who has been successful in the past will be successful in the future, but it turns out to be statistically the best determinant. So you are asking the CEO to begin with, what specific skill sets do you have? What have you accomplished in the past? Specifically, what have you accomplished in the past, and what was your role? Write all this down. The second thing you say is, who's the second most important person in your business? Let's say, just for fun, that he says the VP Exploration. An exploration company, stands to reason, right? So, why did you hire this person? What specific skill sets does this person have? And what have they accomplished in the past? Why is it that I should believe that they are going to be successful in some endeavor? Why is it, what skills, what attributes do they have that are deserving of my money? And the third person, perhaps this is the chief financial officer. You understand what I'm saying. And you need to get very, very, very specific with them. Because after this, you've got this list of people, and you take them through every director. Why was this director chosen? What role does this director have? What role does this director have? What role does this director have? What happens in the course of this discussion is that in at least half the instances when you ask these questions, you will find out that the CEO has assumed that role because he or she wanted to make themselves 2 million shares at a nickel and issue 4 million shares at 50 cents a share so that they could enjoy the step up from 5 cents to 50 cents and live for 2 or 3 years on the money that they raised. That's really good for them. It's really, really, really nice. They get to make a little bit of money and they get to have a nice lifestyle. But mostly, for more than half the companies, this whole thing is a lifestyle and paper trading exercise. And it's really good if you can come to that conclusion early, because you can throw away the presentation and you don't have to waste any more time with them. Very, very, very useful. But you have to have this skills inventory, just in case these guys get it. And you have to go and ask them some more questions, because we're going to refer back to management later in this discussion. The second thing that happens is we've done people, and now we're going to do property. And this is what they love to talk about, right? This is, you go in that exhibit hall over there, and it's interesting. If there was as much gold as the exhibitors say there were, the price of gold would be $100 an ounce, right? I mean, I saw yesterday in that room, I saw, God, I don't know, I saw 20 or 30 10 million ounce deposits. And there's a boatload of gold over there. I mean, didn't have any drill holes in it, but there was a boatload of gold. So you have to have the property discussion with them. And you have to have your notes from the discussion about the management skills, because you're going to let them trap themselves maybe. You say, so now, tell me about your property. And you can blame me. You can say, Rick Rule said that exploration success is answering a series of unanswered questions. What do you think this exploration property is about? Describe the property. Describe what you're trying to achieve. Describe this asset to me. Describe the target size. One thing that I always like early in a discussion is a management team that says to me, everybody out there is looking for these great big deposits. They're going to sell the company. What I'm looking for is a small, high-grade deposit that I can put in production so I can use the cash flow from that and bootstrap and build BHP. Wonderful, seductive story. We're all entrepreneurs, so we like this idea. The problem is it doesn't work. Everything that can go wrong with a big mine can go wrong with a small mine, but a small mine can never make you big money. So if a guy is trying to answer an unanswered question that is irrelevant, in other words, if the guy is looking for a small deposit, bingo, I get to throw him away. I don't have to waste any more time with him. What you're trying to do in every step of the process is eliminate the company so that you don't have to waste any more time with it, and you can focus on companies that can actually make you money. So if the answer to your question is that they're looking for a deposit type and the reward size associated with that deposit type is irrelevant, thank you very much. Best of luck to you. Next booth. Go to the next booth. If, however, they are looking for a more attractive deposit. In other words, if the value associated with a yes answer is high enough that you can afford to take the risk, what's important to determine, and this takes time, what's important to determine is tell me as reasonably as you can, you being a geologist and me being a layperson, why you believe this property is what you think it is. Explain to me the evidence that would support your thesis. Is your thesis that you have a 5 million ounce deposit merely because you need a 5 million ounce story to get me to buy stock? Or is there in fact some evidence which would suggest that this is potentially a 5 million ounce deposit? And let's just say for fun that, you know, they have nice surface geochem, they have good alteration, they have some nice grab samples. They've done a bunch of surface work, which in fact does indicate that they have a large mineralized, body. They have some grab samples that showed some grade. They have things that it seems like a reasonable story to you. The next thing that you say to him or her running this company is, so tell me how you plan to test your thesis. And tell me why the plan that you have chosen, in the first instance, answers the question. But tell me how you're going to get from A to B. And tell me if you get a no answer, what your next step is. Tell me if you get a yes answer, what your next step is. This is important because what you learn, just as when you go through the management team's resumes and you ask for the plan associated with the human resources, about 50% of the time when you do that, you find they have no plan, which is good. Bingo. You don't have to talk to them anymore. Mostly, 50% of the time, when you talk to companies about their exploration plan, what will happen if they get a no answer? Will they drop the property? What will happen if they get a yes answer? What question does that pre-propose? Mostly you will find, in more than half the instances, that they don't really have an exploration plan. Their exploration plan is they're going to drill a couple of holes, try and get lucky. If they get a good result, they're going to try and raise some more money so they can keep at it for a couple of years. Mostly, if they get a no answer, they're going to tell you, well, we didn't adequately test the property, so we have to dream up a new scheme, a new explanation to explain away our failure. It's very, very, very important to note that most of these people don't have a plan. And if they don't have a plan, any success that they might enjoy is random. And there is enough risk in this business that you don't want to expose yourself to random outcomes. So again, bingo, you get to throw the company away. You don't have to waste any more time on it. The point of this whole exercise is if you are, wandering through an exhibit hall that has 300 exhibitors and you have a list of sort of 40 that you've gleaned from your, newsletters or from, unrepentant touts like me on the podium, that you get rid of as many distractions as you possibly can and focus down on what you want. So now, we've gone through the management challenge, we've gone through the property challenge, and this is where it really starts to get fun. You say to the, let's just call it a guy, probably illegal here in San Francisco, it's probably a sexist statement, but let's just call it a guy running the company, and you say, listen, mister, I noticed something interesting and a little troubling to me. You have told me that you are successful in mining. In fact, that you built and operated a gold mine in Archean terrain in French-speaking Quebec, and that's your mining success. But now you're exploring for copper in tertiary volcanics in Spanish-speaking Peru. What is it about operating a mine in 2-billion-year-old rocks in French-speaking Quebec that equips you for exploring for copper in 15-million-year-old terrain in Spanish-speaking Peru? I have an off-color analogy which I love to use. It's early in the morning, but you'll have to bear with me. It's as though you went to the doctor's office for some dentistry, and a proctologist appears. They're both medicine, but the wrong practitioner would leave a bad taste in one's mouth. The nature of this is that not all mining tasks are not created equal. Now you refer back to your notes about the skill sets of the management team, and you say, what part of the skill sets that you described are appropriate to this property? You don't have skill sets associated with the task that you've organized yourselves around today. Why is it that I should give you money to do something that you haven't done before? You haven't been successful. Their answer, of course, is going to be, well, it's all mining. Well, no, it's not all mining. Very, very, very important that you do this. Very, very, very important that you do this. Because by doing just those two things, finding out about the property and about the plan and the unanswered questions, and finding about the suitability of management's existing experience relative to the tasks that they've assigned themselves and that they're asking you to fund, you will eliminate probably 80% of the companies out there. Those two tasks, which you can accomplish in 15 or 20 minutes, eliminates 80% of the confusing data points that you have to screw around with. Now we go one more step. We've done, if you will, in very short form, mines and management. There's one more M. It's money. And this one's fun too. This one's particularly fun because the management teams almost never can answer these questions, which is very, very, very scary. It helps to have a portable computer so that you can pull up either CDAR or EDGAR and refresh the company's management with current data available from filing statements. You need to say, sir, in my experience, it takes 2 field seasons to answer an unanswered question. So it's probably going to take you 18 months to generate the kind of response that's going to get me the value that I need in your stock. If we assume it's going to take 18 months, I have a couple of money questions. How much money has to be spent on the ground over 18 months to get me my yes answer? And let's just say for fun that the guy says, well, our budget is $5 million. And you say, is that for a year or for 18 months, sir? Mostly the answer is, well, I'm not really sure. Well, if the president isn't sure about a $5 million budget, who else is going to be sure? So we help him along. Let's say, I think that's probably for a year, so why don't we assume that it's $7.5 million? Oh yeah, that's probably a good assumption. Yeah, that makes some sense. And tell me, what is your burn rate? How much do you spend on G&A? A surprising number of times when you ask this question sort of pointedly, the guy will say, you know, I think it's about $100,000 a month. Really? Not 50 or not 150? Is it 200? Well, God, I don't really know. I'll get back to you. If you have a personal computer, that's really, really, really handy because you can pull up the guy's quarterlies and say, you know, in fact, you're spending $200,000 a month on G&A. So, to get through 18 months, you know, you're going to need 3.5 million bucks, some number like that, 3 million too. So you're going to spend 7.5 million in the ground, and you're going to spend 3.5 in G&A. Sounds like you need the sunny side of $11 million to get through 18 months to get me a yes answer. How much money do you have in the treasury? What was that, sir? Sir? 2 million. Oh, so you need 11 and you have 2. Any ideas? It seems to me that you're the sunny side of $9 million short of getting me the yes answer that I need. So how am I going to get a yes answer, and how am I going to get a double on my stock if you're going to be broke next quarter? Can you help me through this? I'd like to digress now and tell you a little story. About 25 years ago, a predecessor to this show was called the Boston Gold Show. I don't know how many of you were ever there. It was the one that was before the New York Gold Show. One day I'd been speaking, and after I got done speaking, I was going to fly, so I was in civilian clothes, jeans and a polo shirt or something like that, wandering around the exhibit hall. And there was a very, very, very aggressive sort of white shoe promoter who basically tackled me in the aisle. It was a sort of a slow show, and this is going to be amusing. And I go in, and he was really wonderful, hyperbolic sort of guy, just nuts. And he's going to do this, and he's going to do that, and he's going to drill this. And I said, God, that's very, very, very ambitious, and you're an amazing guy. You're practically doing jumping jacks here. Tell me, what's this drilling program going to cost? And I forget the number, he said. And I said, well, and how much do you have? And he says, well, money's not the important issue. That's interesting. I'm here to learn. Tell me more. This is precious. I hope something like this happens to everybody here at some point in time. This guy, not recognizing me in civilian clothes, said, there's a really hot California broker named Rick Rule who's going to finance me. I heard of this guy. I think he was speaking here. He says, yeah, he's really well known, and he's going to finance me. I said, oh, okay. Why? He says, well, he really, really, really likes the property. He says, the interesting thing is that Rick doesn't like financing companies below $2 a share. And so the opportunity for you is, you buy this thing at 60 cents, 70 cents, and as the stock goes up, Rick finances it at $2, and you get to leverage off his money. No shit. So, if Rick really liked this property at $2, why wouldn't he want to buy it at 60 cents? He says, well, he has issues with low-price stocks and stuff like that. Maybe it's the SEC. I don't know. It's just the way he is. And so finally, at this point in time, I pulled out my driver's license. And, listen, Leroy, I know this Rick Rule really well. So it's important that you ask these money questions with a certain intensity. There is a tendency in this industry to exaggerate. And this is really, truly, for want of a better phrase, where the money meets the road. This is a capital-intensive business, and if these guys don't have any money, they don't have any business. Remember that what you're doing is answering a series of unanswered questions, and answering these unanswered questions takes money. Without money, it's just hyperbole. It's just plain hyperbole. Every dream in the world, every sort of wild arm wave, every good intention, every shred of intellectual capital, in the absence of the money to carry it out, is just completely ephemeral. These guys are selling dreams, which is okay. That's how the world gets built. Dreamers are a wonderful thing. But these need to be really, truly applied dreams. And one of the things that happens, and you can't really get this by interviewing management, you have to do a little bit of work in the numbers yourself, is you have to find out if these companies are truly exploration companies. I presided over an exercise that Sprott did, looking at some number of these penny dreadfuls, maybe 20 of them. And we determined that the median of these companies were spending 65% of the capital that they raised on listing, audit, general, and administrative expenditures, which would suggest to me that 35% of the capital raised went into exploration. The probability of an exploration success backing a management team that employs 35% of the capital at their disposal in exploration is extremely, extremely low. These turn out to be, in many cases, lifestyle companies. And I'm not opposed to anybody living a good lifestyle. I just don't feel any particular obligation to fund it. I pay tax to other people. I don't need to pay tax to junior mining companies. It's, it's very, very, very important that you ask these kinds of questions. And assuming that you have survived all this, okay? Assuming that you like the resumes of management and you understand why the management was chosen, and assuming that you like the property and you like their explanation as to why the property was chosen, and you like the method by which they propose to test the thesis, and you determine that they have or have access to the capital that's required to answer the unanswered question, the next thing that you need to ask them about is the future. If you, let's say that the unanswered question is, we have established on the surface strike, width, we don't have the third dimension. We don't have depth. The unanswered question is we need to drill 3 or 4 holes and see if the surface anomaly projects to depth. What you then say to the person is, okay, you think you can test this adequately with 4 holes? Yes, I do. Fine. What happens if the 4 holes are duds? Do you drop the property? Like, what do you do in the event of a no answer? And what do you do in the event of a yes answer? If you get a yes answer, what question does that presuppose? And this is very, very, very important, because the risks in speculation are such that most of your investment decisions, most of my investment decisions, end up being failures. The expectation is failure. So your winners have to amortize your losers. And the way that your winners amortize your losers is not by shooting for 30% gains. It's by shooting for 1,000% gains. And getting 1,000% gain usually does not happen after answering one unanswered question. You get a yes answer, which sets up a second question, and you get a second yes answer. I have found by back-testing my partnerships, going back many, many, many years, that most of the result came as a consequence of 5 or 6 of my positions, or 5 or 6% of my positions, pardon me. And the average holding period for a 10-bagger, 15-bagger, 20-bagger was 5 or 6 years, which means 2 or 3 exploration season campaigns. In other words, 3 yes answers in succession. So it's important for you in this interrogation process to find out not merely what the value of the yes answer is, but the question that establishes and the value of a subsequent yes answer. What you're doing in exploration is you're trying to be in a situation where the first yes answer gives you a double or triple, but it sets up a second question that gives you a second and a third double or triple. What you're trying to do, if you're rational, is to, if you get a double as an example, sell some stock back in the market, take your capital out of the market and get a free ride on the rest, and then try and get a 10-bagger or a 15-bagger on the balance. And that presupposes that second question. Everybody with me so far? Okay. The next thing that you need to determine is, how am I going to determine your progress? Who is going to tell me? Am I going to get it from a press release, or may I call you? And there's nothing illegal about this. I mean, there is something illegal about obtaining material non-public information, but there is nothing illegal with calling the company's president or the company's vice president of exploration and asking them to interpret the drill holes. Tell me about this drill hole. Tell me what this drill hole in this campaign of 5 drill holes was intended to achieve. And tell me what you think it achieved. And tell me what you are going to do with the data that you got from this drill hole. Very, very, very often what you find out when you answer that question is that the person who is responsible for interpreting the drill holes didn't interpret the drill holes. Didn't think in a granular fashion about what the mineralization, what the alteration that he or she encountered in the drill hole means in the context of their thesis with regards to this property. They didn't think about what answer or what question should have evolved from the data that you paid for in that drill hole. You with me? I know this sounds hard. It really, truly isn't. Because the point of all this is not to get yourself a whole bunch of yes answers. It doesn't happen very often. The point of this is to start with a list of 30 companies and whittle that list of 30 companies down to 4 or 5. You will never, ever, ever in your life get an interview where every question that you answer comes back to your satisfaction. It won't happen. You are not looking for a set of circumstances where you ask 10 questions and you get 10 perfect answers. What you're trying to do is take a list of 30 companies and make it a list of 5 companies, and then spend the rest of your time on the 5 companies. It's important that you do that. For those of you who are interested in this line of reasoning, at our website, which is www.sprottglobal.com, there's an article that I wrote probably 25 years ago called 9 Nosy Questions to Ask Mining Company Managements. And it's a lot of people, I see them still walking around the exhibit hall today with the 9 Nosy Questions. It's sometimes easier to use my questions than to think up your own. It's not as efficient, however. It's very important that you establish your own relationships. I think I've beaten you with enough data and technique this morning. Ladies and gentlemen, I've overstayed my welcome by 20 seconds, and I don't want to cut into the next speaker. I want to tell you that I'm grateful and flattered that you all got up at 7:40 in the morning, and I hope that some of this made it worth your while. Good luck this year, and tell me how the questions went next year. Thank you very much.